Right now, we're actually oversold. We have a Stochastics down to 15, and we're approaching the 50-day moving average of that's the purple line here. The red line is the 100-day moving average, and the green line is the 200-day moving average. So let's look at our meeting notes. In our meeting notes, we see that August is traditionally a bad month, and September is too. So we just started August. We expected to have some bad times in August. We don't have earnings coming out for the most part in August and September, so we don't have that to as catalysts for the stock market to go up or down. We do have NVIDIA coming out with earnings. That's going to be a big driver for the market in the near future. Let's look at when NVIDIA is coming out with their earnings. Okay, so their next earnings, the next earnings will come out August 23rd. So August 23rd, right here, right? It's Wednesday. So not this coming Wednesday, but the Wednesday after. So that's going to be, they've already pre-announced good earnings. So let's see if they make it even better. So we also have at the end of September, we have end of quarter window dressing. We also have triple witching coming up at the end of September on the 15th, and the Fed is going to meet the 30th of September. We have to wait a whole 2 months basically for that. So there's not a lot of catalysts, not a lot of things going on in the next 2 months. And we have summer, which is lower volume, and it is not as there's less people involved, so you don't have as much enthusiasm. Right. So let's look at the S&P has been down for the last week, and we've been down recently. And we have we're losing momentum. So you can see from this link here, we have only 56% of the S&P above the 50-day moving average. Last week was 65%. So we're actually losing momentum. When this dwindles down to 0% above the 50-day moving average, that is the textbook definition of lost momentum. So that's not good for market breadth. And the same thing with the 50-day and the 200-day. It's losing percentages every week now. All right, so we don't have anything really that's going to help the market in the near term. There's no catalysts in sight. The next 2 months are going to be pretty dull months without a whole lot of news coming out. Maybe some government statistics, some inflation numbers. We had inflation numbers come out this week, and I'll show you the inflation numbers. There it is right here. July, we had 3.2. You can see that we've had a steady decrease in the inflation rate since last June. And we expected something lower than 3 this time, but we got 3.2. And that was primarily due to housing. So you can see this in this chart. It says, excluding lagged shelter data, inflation has disappeared. So shelter data, the actual cost of housing is, they're using statistics that are older. So it's not very up to date. And so if you take out shelter from this report, then inflation is not very active. It's not very high. Okay, so now let's go back to our talking points. We are in the worst 2 months of the year, so we're expecting either flat or negative returns for the next 2 months. That's the seasonality. It doesn't work every time, but it just happens to be that that works a lot. You can see in this frame, we're actually in August, which is basically sideways seasonality. So the S&P 500, you can see we're going in an up channel since the beginning of the year, with very well defined top and bottom levels of support. We're right in the middle right now, so we could basically go either way. We can go higher or we can go lower. We're actually super oversold. So we are oversold, but we are in a seasonally bad time of the month. That doesn't mean we can't be more oversold. You can see back in December of last year, we were oversold for a good month and a half. So it doesn't mean we can't stay oversold. All right. Let's look at some of the variables in the stock market. Last week, the oil was $81 a barrel, and now it's $83. We're starting to have oil go up in price. You can see it at the gas pump. We're actually paying more, and that's a reflection of global demand. That means that the economies around the world are picking up and using more oil, usually. And let me see. So right now, that's going to affect inflation if it keeps going up. All right. So now inflation, it's currently around 3%, maybe 3.2 after the report today. And the dollar index isn't changing. And the gold is down just a little bit, down 2%. There's a little demand right now for gold because with tech stocks and a lot of companies going up 30%, there's not a use case for gold right now. Fear and greed index. Right now it's at 64. 2 weeks ago it was extreme greed, and 3 weeks ago it was higher extreme greed. So we're getting more fearful as we approach the bad months of the year. I'm expecting the fear and greed index to be fearful in 2 weeks to 3 weeks, and maybe extreme fear in a month from now. And what could cause us to go into an extreme fear situation? I can say that there's a very good chance that the reason why people will start selling in the stock market will be due to debt. Debt is one of the worst things for stocks and for people to deal with, because if you take on too much debt as a company, you're not going to grow as much, and you might go bankrupt. If you take on too much debt as a customer or a consumer, you're going to have to not buy as much, and you're going to pay a lot in interest, and you're not going to be spending money in the economy, so the economy might go down. So that is a very is probably going to be something that's going to cause a correction in the near future. And that could be because of the United States debt. It could be because of the corporations taking on too much debt, customers taking on too much debt. Right now, there's a lot of people not paying their credit card bills on time. So there's a percentage of people that's probably the highest in recent times of people not paying their credit card bill 30 days. So that if they're 30 days due and they didn't pay it up for 30 days, there's a percentage for that, and it's going up. So there's just a hint that the customer is being putting a lot of money on the credit cards and getting into debt, and that might affect the economy, and it might affect the banks, and it might lead to some kind of situation where there's maybe a recession. I don't know. But we'll keep our eyes on any indication that the corporations or people of America are going to be overextending themselves. All right, so let's look at the dollar index. You can see recently it's been going up for the past week or two, but we're still in a downtrend. So as this is going in a downtrend, it has it's a two-edged sword. Number one, if it goes down, then the value of our dollar that we've saved goes down. So you're not going to be able to buy as much with that. And the other edge of the sword is we have companies like Microsoft and Google and Apple that are selling overseas. And if you sell your product overseas and you repatriate that money to America, then there's a very good chance that you're going to earn 10% more or something like that if you make a lot of sales overseas and the dollar is weak. So let's look at the VIX. Right now the VIX is low. It is super low. It is near the low for the past couple of years. It hasn't changed since last week. Right now people are not fearful and they're not buying protection. They are very bullish and they're riding the current wave of stock market going up. So let's look at where we are on the valuation, the emotional graph. Right now there's a lot. We're in our fear greed index. We're still greedy, so you could say that we're here. We've kind of reached a peak in the stock market. We're starting to go back down, so it's a very good chance we could be right here, returning to normal, and we know we might be right before a correction because these 2 months of the year are bad. So the key ingredient of investing is that you can't let your emotions take over your investment decisions. So if you see the stock market going down, you see people that are fearful, you can't sell whenever everyone else is selling because that is the worst time to sell. You get bad prices and you don't know when to get back in. So let's say you had a profit of $1,000 on a trade. Let's say you bought Microsoft, it ran up, and Microsoft's starting to go back down. If you sell Microsoft and during a capitulation time, let's say you have $1,000 profit unrealized in Microsoft and you sell it because you're afraid it'll go down, number one, you have to pay 20% capital gains tax on your profit. So you immediately have to realize that to $800 gain. So you make $800 from that transaction. You also have to reallocate that money into something better. So you need that something that you put it in has to be at least 20% better than your prior investment. And you have to know when to put that back in. So whenever things are selling off, it is going to be super hard for you to time when to get back in and how to get a better investment than the one that you sold out of. So that's why we have this graph here, so we can realize, this is capitulation, not the time to sell. And also, we have to recognize whenever things are going crazy and everyone's buying, you don't want to be the person that buys at the top and everyone else is selling. All right, let's look at some breaks and trends. Okay, in the stochastic charts, I noticed that we've had an uptrend for a year since the beginning of this year with Apple, and the S&P 500. You can see that there's a well-established trend line that I drew in black, and that has been very faithful until after Apple released their earnings. And you can see that they broke out of that, and they're basically hitting their moving average right now. So let's look at this Apple. Okay, so usually whenever it breaks out of this channel, that makes the uptrend in Apple less predictable, and it looks like Apple is actually a leader in the market. So if a stock like Apple goes out of its range, then there's a very good chance the S&P 500 might break out of that also. And now Apple is still above their 50-day moving average. But if Apple and a bunch of other tech stocks go below their 200-day, 50-day, 200-day, 100-day moving averages, then we've lost some of the leaders in the market, and the momentum in the market has basically fizzled out. If that happens, then we end up going into a trading range, something like this, for a lot of stocks instead. All right, so now let's look at another break-in trend from this week in the stochastics that I looked at. You can see that a lot of the drug stocks have been in a downtrend for a year or so this year. And this is Amgen. It basically just broke out right there of this downtrend that's been going on since last November. And so we're establishing maybe a new higher high and new higher low. And okay, break-in trends work both ways. You know, we've had the whole stock market break a trend downward at the beginning of this year. And right now it seems like a lot of the drug stocks and a lot of the energy stocks are breaking down out of their established downtrends into uptrends. All right. Now, I saw an article on Tapestry, and they basically acquired Capri. Capri is a both of these companies sell handbags, lower end handbags, and Coach. I mean, some of the name brands of Coach. Let's see, hold on. Okay, Tapestry owns a lot of name brand handbag companies. They're like a conglomerate, and their main competitor was Capri. Now, Capri, we were talking about last year. We saw that at a PE ratio of 5, and I thought it was really undervalued. But it didn't make sense why all these stocks were trading at a PE of 5 to 7 when all the other stocks in the luxury world was selling for a lot of PE higher than that. Okay, let's look at the PE ratios. Let's look at the PE ratios of other luxury brands. LVMH, I know, Mark, you own this one. It has a PE of 33. Burberry has a PE of 1,000. Nordstrom 167. Hugo Boss 30. Pandora 18. Now, the stocks that are involved in this transaction takeover today have a PE of under 10. So if Tapestry is able to pay off its debt and raise its prices, and then it would probably trade up to a PE ratio of 30 like the other ones. And if so, that's like several times where it's trading at now. Okay, so now let's look at the statistics for Tapestry, TPR. They have a PE, forward PE of 8. And Yahoo Finance says its PEG ratio is 0.77. So that's like 23% undervalued, according to Yahoo Finance. Profit margin is at our bare minimum 13%, which is good. Return on equity is 37%. The one bad thing about this company is they have some debt. They have $3 billion in debt before today, and now they bought a $9 billion company. So they have $11 billion in debt now, and their market cap is only $8 billion. So they have to make it a super high priority to pay down the debt, and if they're going to be able to grow. Okay, so that was good exercise. Let's see what CFRA says about Tapestry. They say our buy opinion and price target reflect our view that it's very well positioned in to maintain their margins and EPS as the economy slows. So this is a consumer-driven company that a lot of people buy their purses, and it's not a business to business; it's just the consumer. So their direct-to-consumer channel makes up 90% of sales. That is amazing. That's just like Nike. We were seeing how Nike is changing their business model to direct-to-consumer, and that allows them to improve their margins. And 10% comes from its wholesale channel. So, okay, so they see catalyst in selling in China. And as soon as China gets back to normal, right now China is kind of really doing bad. Their economy is doing bad, and they're getting over COVID. The TPR maintains a fortress balance sheet, continues to return capital to shareholders. They're repurchasing shares and have a quarterly dividend. So TFRA says that they're 35% undervalued. So let's look at the E-Trade earnings estimates. These are the average earnings estimates for all analysts. It says they're growing around 12%. What I did was I divided 23 by 24, 390 by 425, and I got 9%. Then I got 12%, 18% for the next couple of years. So they're growing around 12%. The 8 PE ratio. So if you divide 8 by 12, you get 0.66. So that matches what we saw in Yahoo and we saw on CFRA, where it's about 30% undervalued. Now note that this went down 18% yesterday on this takeover news. So all these numbers could be off by a little bit, but it's still undervalued. So it went down 18%. So now let's look at what Morningstar says about Tapestry. They say they have a narrow moat. That means there's a lot of competitors. They don't really have a good niche. All 3 Tapestry brands suffered sales and operating profit declines during the pandemic. So every company that had a problem that's a one-off, well, we can't really say anything bad about companies if they had problems during the pandemic. Okay, so their brand strength and pricing power continue to provide a narrow moat. Coach has some difficult years. They're trying to turn it around through store closures, restrictions on discounting, and increased e-commerce. So that they also agreed that this increased sales online to the end consumer is going to help. Okay, so they think it's worth 30% greater than where it's at now. So their fair value is 57. It's currently trading around 35 right now. So it's actually 35 or 40% after today because it went down to 18%. So they think it's undervalued. So this was a really nice exercise to do. what I did was I threw out another stock called PVH Corp. Jim Cramer likes this stock. He always has the CEO of the company on Mad Money, and he always asks him questions about going. This company owns the Tommy Hilfiger, Calvin Klein, and Heritage brand, and in their see, what I did was I looked at their estimates and I looked at their statistics to see maybe if there was some value here. PVH has been down. PVH, their stock has been down a lot, and I'm going to show you the chart for this. I'm not sure. Well, if you get a tip from Jim Cramer, you really have to make sure it's right before you. It makes sense for you before you buy it, because some of his picks are not so great, and some of them are great. So this one hasn't really done anything for. Go back 4 years, it hasn't done anything. It's at the same price it was in 2017. So 6 years ago, it's basically hasn't done anything at appreciate at all. So that's not very reassuring. Let's look at so PVH. They sell clothes, apparel, and other items under those brands. And so right now they're growing at around 16% if you average all their growth rates. If you divide this number by this number, this number by this number, you get these numbers here, 14, 15, 20. So let's say it's growing at 16%. The PE is 26. So the PEG ratio is 1.6. They are 1.6 times overvalued. So it's not a very compelling stock for me. So I wouldn't be interested in this. Its market cap is $5 billion. Their forward PE is 8, and their profit margin is very low. It's 2, and the return on equity is only 3.9. And they have a lot of debt. So that 3.7 billion out of their 5 billion is debt. So not only they paid a lot of money to acquire these brands, Tommy Hilfiger, Calvin Klein. So they're still paying that off. So that's going to hurt their growth going forward. So if you put it all together, it's not that compelling of a story for me, even though Jim Cramer recommended it. Okay, this is a very challenging environment. With retail, you have to have inventory. If you make too much, then you have to sell it at a discount to TJ Maxx. There's a lot of, and then you're at the mercy of the customer tastes for your brand. So it's very challenging, and they don't have a moat either. The brands aren't the best, so I would stay away from this one. Let me see. All right. Okay, we were talking about the CPI. We were talking about the CPI, and that came out it's a government statistic about inflation that came out this week. Shelter data was the only statistic that was high in inflation. And that really, without shelter data, there would be no inflation. So, and the shelter data is actually lagging. So it's not like current information, it's from several months ago. So there's a very good chance that inflation is under control, and based on what this guy is saying here. So if inflation is under control, if there's any stock that is going down or investment that's going down because of rising interest rates, we might now know through this that we're basically over that problem, and we could start investing and consider this as a no-up. And all right, so let's look at the inflation rates since last June. We've had 9.88 consistently going down, not to where we're at a 3.2% interest rate. I mean, CPI, core inflation rate. So, so there's a very good chance that we're going to continue to go into the twos pretty soon. And that's what the target of the Fed is. It's around 2%. So that leads us to believe that the interest rates are done going up. All right. Okay, so I did a screen using Fidelity. Let's open that up. Every once in a while, I like to do a screen just to see what stocks are out there. What I did for this is I cut and pasted the output for the screen to a spreadsheet, and then I sorted each column based on the specified criteria. Say for PEG ratio, I highlighted the best 5 in red. So the lowest PEG ratios I highlighted in red, and the next 20 I highlighted in yellow. So what that allowed me to do is for each column, highlight in red the best numbers. And then what I do is I look to see what companies have the most interesting combinations of red and yellow. And that's how I do my research for next stocks. And you can see that there was one stock here called EQT with a PEG ratio of 0.15. That is pretty unheard of. And I said, well, and it has some great numbers here for return on equity, for growth rate. And I said, let's look into that. And it's a stock I've never heard of. It's a small stock. Let's look at it. We usually look at the big market cap stocks. It's like the market cap of $1 trillion, a couple $100 billion. But this happens to be a stock that's $15 billion. That's pretty big, but it's still a smaller stock. Let's look at what the numbers are for that. Okay, so we can see that it lost money from last year to this year. I'm not sure. I couldn't find the history of that. But if you divide this year by next year and 24 by 25, it's growing at 50% from this year to next year, and 24 to 25, it's growing 34%. So we're going to average that in at 40% growth. Their PE ratio is 17, so they're at 0.4 PEG ratio. That's not the same as the 0.15 we saw in our screener, but it's still pretty darn good. But what I do is I just, whenever I see a stock on the screen and I don't know anything about the stock, the first thing I do is I go to Yahoo Finance, and let's look it up, EQT. I like to look it up on Yahoo Finance and EQT. And do a profile of the stock. It's right here. So the interesting thing about this stock is the company was founded in 1878. That's pretty darn amazing. Just a random stock we chose that had a good criteria. They operate a natural gas production company in the United States. It must be successful. If they ran the company for this long and they're still in business, that's impressive. It's headquartered in Pittsburgh, Pennsylvania, and so they're basically at the mercy of the price of gas. So let's look at. Okay, let's look at the. Okay, you can see. Let's look at a couple things on this. We'll look at the statistics. Okay. You can see that PEG ratio of 0.71. Okay, that's Yahoo Finance, and They say it's undervalued by 30%. You can see their profit margin is amazingly good, 40%. Return on equity is 33%, which is also really good. And total debt is $4 billion. That's half of their market cap. No, it's 1/3 of their market cap. So that's not that bad. That's okay. So let's look at. So if they're growing at 40% and their PE is 17, that's a pretty darn good stock. But it's a smaller company, and the price of the stock, the way the stock goes up and down, is based a lot on natural gas price. Let's look at natural gas ETF. Here it is, right here. There's a ETF that it's an ETF that tracks the price of natural gas. And let's look at the price of natural gas and see. It's been going up recently, but for the past, it's very volatile. Look at this. The price of natural gas during the pandemic was $3 a share. And wow, that's a huge variation. So I don't know a whole lot about gas or oil investments, but this looks very interesting. Enough to do some more research on it, I guess. Okay, I'll look into it for next time. But that was a good little exercise. Okay. Okay, let's look at what's going on in the stock market now. And the stocks that are going up the most and down the most. You see. In the sectors, we like to look at the sectors. The stocks going down the most are semiconductors, technology, and materials home builders. So a lot of times interest rates have a lot to do with what sectors go up and down. We had a rise in interest rates this week because there was a treasury auction for United States treasuries that didn't go very well. So they had to offer higher yield to treasuries. And if there's higher yields in the treasuries, that's bad for tech stocks. Any company that needs to borrow money to grow will not do good when the treasuries go up. And also on the flip side of that, when that happens, you have a demand for safer investments. Let's look at, and then what's going up the most today is energy, oil, healthcare, utilities. These are stocks that pay dividends. These are stocks that are safer and stocks that do well whenever interest rates go up. Now, let's look at some of the stocks in the stock market movers. Up and down, we see News Corp, Axon. Axon is a company that does video for police departments, and they basically give the video devices away to the police departments, and they charge for storing the video on their servers. So let's look at Axon, AXON. So they almost have a monopoly in police storage of video. There used to be the company that made tasers, and they moved towards making a product that stores videos for police departments. Their forward PE is 69. I'm going to pull up their growth chart. That's a very high PE ratio. What else can we see about AXON? Axon. We see the market cap is 15 billion. So when the trailing PE is 152 and the forward PE is 69, that's a good indication that they're doubling the amount of money they make, or they're much more profitable this next year than they are this year. Let's look at some of their debt. That total debt is 707 million out of 15 billion. That's not that much. All right. Let's look at profit margin is 10. That's great. Return on equity, that's at our minimum 10. Okay, so it's bare minimum of efficiency, profit margin and return on equity. So that's okay. It passes those. Let's look at the actual growth and see if they're growing at 69%. AXON. Oh, this E-Trade says their PE is 152. A little different. Let's see what they're, this isn't much at all. We don't see a whole lot of, there's not a lot of analysts covering the stock. So 219 divided by 3.36. That it grew 35% from last year to this year. 3.36 divided by 3.77. 10%. It's maybe 11%. So it's growing 11% and has a PE of 69 or 150. This is by all means a very expensive stock. So it is 6 times overvalued right now. So Warren Buffett went and looked at this one, I don't think. Okay, that was a good exercise. We saw that in the top 10, so maybe there was something there. We see that VF Corp is in the top 5. I'm not sure why. Maybe because when there's an acquisition, VF Corp was the stock we just looked at. Whenever there's an acquisition like Tapestry bought Capri, maybe their competitor might be bought, and that's why there might have been a bid for this company. We see a lot of oil companies in the top 10. Maybe that's because of, let me see, Prima. Let's look at the price of oil to see if the oil went up this morning. Okay, crude oil is up less than a fraction of a percent. So it's been on its way up. It's up 2 or 3% since last week. All right. Okay, so that's probably why oil stocks are going up and down today. Look at market moves. Okay. I'm not sure exactly why. It's only up to 0.28%, but you have all the well, they do pay dividends and they are more conservative. Maybe it's because we also have a switch from tech stocks recently to oil and healthcare and drugs. So we have News Corp, we have Occidental, which is a oil company, Valero Oil, Marathon Oil. Okay. And ones going down the most are semiconductor companies. I don't know why the semiconductors are going down, but they're down 3 to 5%, which is major down. All the earnings are out, so there's no real catalyst for stocks to go down or up. Maybe it's just today we have high PE stocks going down, low PE stocks going up. That's the theme for today. The lower PE stocks, like the drug stocks, they would have a tendency to be safer. We see a lot of those in the top 10 of the NASDAQ. One's going down the most, all high PE stocks in semiconductors. Okay, Dow. Healthcare is doing the best in general in oil. All right, that was a good lesson learned. All right, so now we are going to go back to our talking points. Okay, so I do this every now and then, a review of what makes a good growth stock for buy and hold. We've been looking at E-Trade's graph, and what this E-Trade's graph is, it maps out the earnings estimates for the stocks in the forward years. So if you add up all the earnings estimates for the stock for all analysts and divide by the number of analysts, you get a number. If you divide this number by this number, you get the growth rate between these 2 years. And we like to see stocks that are consistently growing higher, their earnings. And we have these ratios that we look for in our screens. Return on equity, we like to have over 12. Profit margin, we like to have over 12. Market cap, we like to have over 50 billion because it's more, it's safer. Usually it's safer and it's more reliable. We like to have a forward PE of, it's low compared to its growth rate. And the growth rate we like to have over 10%. And you divide these numbers together, 22 by 23, and you get a number, and that is the growth rate. And we like to have greater than 10. PEG ratio. We like to look for stocks that have a low PEG ratio because they're fairly valued. If they have a high PEG ratio, they're overvalued. That doesn't mean you can't own them. A lot of the best quality companies in the world trade at a high PEG ratio because they're more reliable. So you pay more for a car that starts every day. So you pay more for a car for a stock that is high quality, that's going to be consistently earning money, and it's going to be reliable over time. The other stocks, the criteria, the other criteria we're looking for that's not something we can really screen for. We gotta, some of it's common sense. We like to have high free cash flow. That's the amount of money that you have after you have your expenses taken out of your earnings. And you want annual earnings increasing in a straight line, just like you have in this picture here. We have a low PEG ratio, return on equity greater than 10. The company has to have a competitive edge. That means that a lot of times you have a competitive edge, you can charge more over time, and you have a maybe a patent or some kind of something that sets your company apart from other companies, and that allows you to charge more. And dividend, that's always a bonus. That adds to your total return. We like to see highly transparent and predictable growing earning streams. Little or no debt, and company has to have good management. So that's kind of what we're looking for. I like to go over this because it's what I use for all my screens, and it's the way I go through a new idea whenever I'm going through it. In Yahoo Finance, you can see these at the statistics tab when you're looking up a stock up. So you see a market cap, the forward PE, and the PEG ratio, all on the same page as the profit margin, return on equity, and the total debt. You also see the dividend on the same page. So, but I do my screens on Fidelity, and I do my research, a lot of my research on Yahoo Finance. Okay, I like to go back to this great comment. A lot of beginner investors are fearful of the times when the stock market goes down. But if you look at the times from 1960 to let's say 2017 in this picture, you can see that the bad times are dwarfed by the good times in the stock market. So there are sayings that say it's harder to suffer losses than it is to hold during the good times. So selling whenever you have a very small portion of, total investable time of your stocks going down. Because if you hold your stocks, there's a very good chance that, let's say 70% or 80% of the time, the stock market's going to be in a bull market where it's green, going up, etc. So I'd like to also finish with the idea that stock market investing is it's not a lot like gambling in the casinos, because the longer you spend at a slot machine, the better chances you have of losing, because the odds are against you. And if you invest correctly and if you do your research, you do have a 50% or greater chance of winning in the stock market. And the longer you hold your stocks and investments, the greater the chance of success for you. So if you buy and hold, let's say, an index like an S&P 500, and you hold it for 3 years, there's a 40% chance that you'll be positive at the end of those 4 years. But if you hold 8 years, there's a 75% chance that you're going to be making money after 8 years. And if you buy and hold up to 12 years, then there's like a 90% chance that you'll be making money. So the longer you hold your money, the better chances of success. And that's why I basically buy and hold, and trust that the company will have good and bad quarters, but they're making progress to making money for the investors. All right, that's basically all I had to say for today. I hope you have a really good weekend, and I'll see you next time.